Welcome to the Commercial Real Estate Podcast, powered by First National. I am Adam Pawadic, sitting here with Aaron Cameron at a quieter moment in the RealCapital conference. I want to thank, of course, KingSet Capital for sponsoring our video speaker series here at the forum. And I want to welcome our guest. We've got David Ward, who is the Executive VP and Chief Operating Officer of Canadian Urban. He's in from Alberta, visiting us at the conference today. David, welcome.
Thank you very much, Adam.
So we're going to jump into your backstory. We've never had anybody from Canadian Urban on before, so we're going to get into set the stage too for anybody who's not super familiar. But of course, Canadian Urban is a well-known name, so we'll assume some knowledge. But for you personally, let's jump back in time. You know, how did you first get into real estate? What led to the career? What led to you sitting here with us today?
To be honest, I actually am from Toronto. I've come through the ranks of Morguard Investments. I was there for over 25 years, and I'm fairly new to Canadian Urban. So my background is in asset management and investments. I've really, I guess, gravitated towards the industrial sector more than any other asset class. And I've sort of worked my way up through Morguard, and was 3 years ago got the opportunity to join Canadian Urban as a senior vice president of asset management, and it seemed like a great fit for me. I was ready for a change, and we're a sort of a entrepreneurial sort of boutique real estate investment firm, and we have a great portfolio composition, and it was exciting to be part of. And right now we're in the capital raise mode for a new open-end fund. So my role is basically I'm overseeing the investments, the asset management, property management, the total operation, based out of Markham. Our head office is in Edmonton, and we're really trying to spread our influence in Eastern Canada, attending conferences like this, being active in these conferences, selfishly to raise capital, but also represent our company and really sort of spread the message of what we're doing.
I know you've only been there for 3 years, but maybe just tell the Canadian Urban story.
Yeah, it's the company's been around for 53 years. Always been Edmonton based. Always had a loyal client base that there was never really a concerted effort to really grow the business. It was always sort of, between $1 billion and $1.2 billion in AUM. And it was sort of steady as she goes. And there was never really a concerted effort to build the business. And recently, our Jay Hamilton, our president, really took the bull by the horns and is dedicated to growing the business. And we've converted an existing segregated fund owned by a large Canadian pension plan, and we've converted that fund into an open-end fund, and the portfolio composition is really good, and there's tons of upside. So we're going to the market, and this pension fund's our seed investor.
Great. So maybe just talk about the funds you have now and the composition of the funds.
Yeah, so I would say our book is, as I said, $1.2 billion in assets under management, about 3.5 million square feet. We're in all markets, right from Vancouver to Halifax. And, I'd say the composition is 50% in industrial. You layer in multifamily, that's about 2/3, and then the balance would be made up of suburban office, downtown office, and grocery-anchored retail.
It's all core, cash flow, value add, or is different funds
it's
for
pretty
each?
It's pretty much all core. We have about 15 different clients, and they all have different mandates. Some are more geared towards value add and opportunistic. But for the most part, we are a core fund manager. But, our group is really entrepreneurial. We're really hands-on. A lot of our mandates are discretionary. So we are able to, make decisions on buying, selling, and managing the whole asset cycle or whatever, and really making the decision to cull portfolios and redeploy the capital into something more productive.
Well, with that composition, you must have been sleeping well during the turmoil of the last couple of years, some of the storms with that kind of build, with that kind of portfolio. Core industrials perform very well.
Yes.
Core multifamily courses perform very well. Do you look at some of your competitors and just kind of wish them the best and to go to sleep, or what's the view with the kind of resiliency over the next couple of years in the portfolio?
Well, I think one of the messages that we have when we're trying to raise new capital is, as I said, we're a boutique sort of entrepreneurial firm, and our portfolio composition is really good. But we've been able to be number one ranked in the MSCI real estate index in income. For super regional, excluding super regional malls. So we've been number one ranked since 2000 in income returns, and that's a real positive in our view. And I think we're probably top 5 or 6 in total returns out of 25 of our competitors. So our track record is really good, and our existing clients really appreciate that, and they stick with us. We also have a prominent European family. I won't mention who they are, but we're the exclusive advisor for them in Canada. They're quite active, and they play a big. That's a very important relationship for us. So really, what we're trying to do is we're trying to work with our existing 15 clients and maximizing returns and working with them to grow their portfolios, and at the same time with this new fund, this open-end fund that I was referring to, attracting new investors, and one of the reasons why we're here today, and in a portfolio that has tons of upside. So we're pretty excited about that.
With capital raising comes sort of deployment of capital. Is the strategy changed at all? Is it rinse and repeat?
I think the strategy is really just to highlight the fundamentals of your portfolio composition, right? I mean, everyone, you talk about the challenges of fundraising, and to me it all boils down to what is your composition, and for this new fund that's now open end. It's 80% industrial. It's got a weighted average lease term of 3 years. The mark to market on this fund, as far as rental rates goes, is 50% below market. So we're in the midst right now of building off $6 or $7 rental rates with our existing tenants, with the intent to be bringing it up to $16 or $17 in the next 3 years. Like the net operating income for this existing fund conservatively will go from $17 million annually to $26 million, just based on renewing all these tenants to market. And I understand that. We've heard this morning that industrial fundamentals are kind of softening a bit. But in my opinion, and I've been an industrial guy for 30 years, the rental rates aren't coming down. They're softening, the growth is softening, but the rental rates aren't coming down. So I don't think there's many other fund managers who are out there trying to raise capital that can say that with any sort of sincerity, that this is a really good opportunity. So you have an opportunity to buy into an existing fund that has tons of upside in the next 3 years, and then you have the opportunity to partner with an existing seed investor, who's in it for the long haul and is a very passive sort of well-known pension plan.
Your panel later today is on the challenges of fundraising. what do you think the general themes are going to be? I know usually there's a pre-call where everybody kind of shares their thoughts, and maybe it wouldn't be specific to your groups. It sounds like you're well positioned to raise capital, but market wide, what's the biggest challenge right now in fundraising?
Well, I think, like our initial approach to raising capital in this new open-end fund was to sort of do smaller incremental sort of private equity or smaller investors. But when we really realized what we have to offer, we're going after bigger fish. We're going after more of institutional investors that can make a bigger splash, like 50 million or 100 million in equity would be awesome. So I think we really have to really sell the upside. And the problem, though, is the denominator effect that's happening right now. So what we keep hearing and what we're experiencing is that for institutional investors, having their real estate allocations out of whack on the numerator side relative to their total investment book, they're under very strict obligations to maintain that ratio of whatever it is, 10 to 12% in real estate. And suddenly, real estate values have declined 10 or 15%, but the income, the fixed income and equity, other investments have declined even further. So they're under very strict obligations not to continue to allocate more capital into real estate. So that's been our biggest challenge. The other challenge we have is our name, right? Our brand. We've been Edmonton-based. We've been around for a long time. We've done some great stuff, but we're still sort of like an emerging manager as far as being in the open-end fundraising scene, and so that's been a bit of a challenge. Getting our foot in the door has been a challenge, but I think I can say this. I'm probably not going to say this in our session, but we've aligned ourselves with Jamie Ziegel of Ziegel Advisors, and Jamie's like he's a veteran, well-known real estate player and investment banker for 30 years, and responsible for been part of like 50 billion in transaction values throughout his career. He's hooked up with us in terms of helping us get in the door, getting into seeing investors that would be interested in this. He's a big believer in mid-market, which is our bailiwick, or $20 to $60 million. That sort of $60 million is sort of the sandbox that we play in, and it's we've been able to find accretive deals. We've been doing off-market deals. As opposed to the institutional market, which is north of $100 million, where, it's capital markets driven and it's a feeding frenzy whenever,
there's 5 assets a year that trade in that.
Exactly.
That type.
Yeah. And the mid-market advantage is that there's, it's a fragmented ownership. There's lots of owner-occupiers, and, there's reasons for them to sell, and we can tap into the local brokerage community to make things happen. So we find creative deals, and the proof is in the pudding when we, with our record on the MSCI index.
Any discussion or any history of development, or is it all cash flowing existing assets?
Yeah, we're income producing. Sort of
a merchant buyer. I don't know if that's the right term, but you buy off of developers. Do you have those partnerships, or is that kind of just if the opportunity presents itself?
Opportunity presents itself. Yes, I mean we often seek when we acquire product, if there's excess land that could be exploited or further developed. I mean that's part of our thing too. But again, really entrepreneurial focused and we're always looking for further sort of juice that can be had, and that's the beauty of the mid market. Like there's we're active in Brampton, Laval, Saint Laurent, Cambridge, Calgary, Vancouver. We're all over the map, but we're in sort of high growth markets, and if there is a value add opportunity and if we can sell that to our investors, we certainly do that.
That's the fun. Back to the just finding the fundamentals that make sense, right?
Yeah.
One of the things that's come up regularly when we have these types of discussions, particularly on the fundraising side, and more predominant now in 2024, even though we're only, whatever it is, 6 weeks in, for that capital looking to invest, they have an ESG mandate, and it's becoming table stakes and maybe the first question out of their mouths. How has Canadian Urban sort of adopted or adapted to that?
Yes. I would say we've come full circle in the last year and a half. We've brought in a champion, Zaina Elali, who is very prominent ESG advocate. And we've got our GRESB reporting. We've got green leasing, green leases happening right now. We report on energy and water consumption. All of our buildings are now being certified as BOMA Best and that sort of thing. So we're looking at solar panels. We're converting LED lighting, like all that stuff. So we are definitely on the right track for that, and it's obviously really increasingly important. I selfishly am a real estate guy. I always just think of it as a value add thing. Okay, we ticked off that box, which is good, right? But I am concerned. I'm a recent grandfather, so I'm concerned about the world for my grandson. But selfishly, it's imperative. Tenants are looking for it, and obviously investors are the same. So,
Well, is it table stakes yet? As you said, you're actively pursuing kind of institutional money right now.
yeah.
Is it table stakes yet in Canada that you need to have a very well developed ESG program?
Oh, 100%. Any of the pension funds or institutional investors have very strict ESG requirements, and we have to demonstrate that program. And as I said, we're on the right track. It's fairly new to us since we brought Zaina in, but we're definitely. I think we're positioning ourselves very well.
It's complicated, right? Because there's a tug of war between doing the right thing and the necessary thing to attract the capital, but also still maintain an ROI to meet the capital needs.
Yes.
How do you balance that?
Well, I mean that's an interesting point. Some of our we have 15 clients, and some of them are very motivated by sustainability and making sure that happens. But others are like, the heck with that. I just want to maximize returns. I don't want you to be spending money on ESG initiatives, and that's the bottom line. So yeah, it's a balancing act, but I think overwhelmingly, like the majority of our clients are definitely motivated, and that's as important as tenancy. Like it's in occupancy and income is ESG is right up there, and that's certainly of critical importance.
What about we always talk about real estate. You follow the capital flows. You mentioned a European relationship. Are you finding it's more of a Canadian investment base, European investment base? Is there Asian capital? Like, where are you thinking, or where do you guys believe there's the best opportunity to raise capital?
I think in our own backyard, basically. We've again, based on our tenure and history, we've had long-standing relationships with Canadian pension funds, and that's sort of our first sort of
the first knock.
Yeah, exactly. We want to just keep that going. Now since we've gotten in this open-ended marketing campaign, we're looking at family offices and sovereign wealth and all sorts of it, wherever we can find it. But like today, for example, I'm speaking on this panel, and I want to tell our story, and I'm hopeful that there's one or two members of the audience that want to learn more and see how we go.
Are the capital goals of a sovereign wealth fund that different from, say, a pension fund, that different from a family office?
No idea.
No idea. Okay, fair enough. I wanted to ask you about, it might be a delicate question, but office. We've talked, of course, about the strength of being in core industrial and multifamily being a great thing, but you do have some office exposure.
Yes.
How are you managing the office exposure? Are you looking to trim that in the portfolio? Are you undergoing strategies to kind of preserve the NOI in these buildings? How are you handling that aspect?
Great question. Spending a lot of money to prop them up. But I would say this, I really think that there's a real sort of, I hate to use the word bifurcation. I just don't like that word.
It's already been used once today on this podcast.
It's actually Adam's favorite word.
Yes. But I think there are some separation within various sectors in terms of overall performance. So, like, not all office is created equal, right? And there are differentiators like quality, sustainability, tenant roster, location. I mean, none of this is new, but I really think that that there's a gap widening within sectors like the office sector, and it's almost as equally as important to the gaps between sectors like office and industrial, right? So, and then you have all these subsectors that are coming in like student housing or senior housing and self storage, life sciences, lab space. Like I think there's all these subsectors that are developing. So I think we're kind of in a position now where we're going away from, being so focused on the four food groups like multifamily,
buy the pound real estate,
right? where there's all sorts of there's all sorts of gaps that are existing within sectors. So I wouldn't rule out office, for example, if it ticks out a bunch of boxes and you can get it at a high cap rate and you have an impressive tenant roster that's maybe set long term, why not? So I think investors like us shouldn't be so rigid in geographic diversity, especially in the mid-market segment. Shouldn't be so focused on that and not be eliminating, well, we can't invest in office, that's no good, right? Like I just think there's too many opportunities, and especially when we're approaching the bottom of the cycle and that pricing cap rates are going up and pricing's, there's going to be motivated sellers who are faced with this wall of debt that's coming due. 35% of commercial real estate mortgages are coming due in the next 2 years in North America alone, and I'm pretty sure not all of them can pay off the penalty or the debt, and there's going to be opportunities. There's going to be, I don't want to use the word distress sales, but there's going to be people that are forced to sell, and you got to look at it every opportunity regardless of sector.
I like the idea of real estate from a more nuanced perspective, because in retail, it's been accepted for a long time. You say, well, yeah, but what kind of retail? And if it's the right kind of retail, it's, right. Oh, yeah, I know it. It just because it's so visible and easy to identify. Office, it's a little less obvious, because now you don't go by an office building and know who the tenants are or what the profile is, where as retail, it just, it's advertised right in your face when you're going by. We're just about out of time here, David, but maybe we'll revisit the capital raise one more time, as we always like to get a forward-looking view. What's it look like a year from now, capital raising? Better or worse than it is today?
Well, I guess it all depends on what happens with interest rates, right? And we heard from Benjamin today that he's confident that interest rates are going to go down. I think a lot of the institutions and pension funds have been embarking on a rebalancing exercise. So I think the logjam for available capital will break. And if you can sell a story like, here's an existing portfolio that's 50% mark to market and rents in a sector that's performing very, very well. It's 80% industrial. I think it's pretty tempting for somebody to commit to us, and that's our goal.
David, I want to thank you for coming today to share your thoughts. You do have a panel coming up later today. I hope this is a good exercise and kind of
get your thoughts formed.
Yeah, get the juices flowing.
Definitely.
On And trying not to gloat too much on the panel about your office composition, because I know that not all panelists have the same luxury. I want to thank Kings of Capital for sponsoring our video speaker series here today, the Real Estate Forum for hosting us at RealCapital, of course, First National for powering the podcast. But David, above all else, thank you for coming on today.
Well, thank you guys. They were great questions, and yeah, it's a nice warm up for me for this afternoon. So that's great. Thank you.
Great.